Okay, welcome back to Rental Properties for Idiots. Today we are going to talk about the implications of selling a rental property after owning it for a certain period of time. So remember last week we talked about some important concepts, one of them being depreciation. So depreciation is basically deducting the cost of any asset that you place into service. So for a rental property, if it's a residential property, I'm deducting the actual cost of the building, the structure, over 27 and a half years. If it's a commercial property, it's 39 years. You can also take depreciation on other assets, like if I buy, an AC unit or something for the property, we depreciate that separately generally. And then same deal for like windows, a lawnmower, anything like that. And we have different depreciation methods and useful lives for each type of property that we place into service. So remember that when we're talking about gain calculations. So here's kind of a scenario for you that it's a common misconception for a lot of people, and it's important to kind of walk through it. So number one is I buy the property for $100,000. So I purchase a building, let's say it's a residential building for $100,000. And then maybe a few years down the road, I decide to make some improvements. I dump another $20,000 into improvements that year. So the actual building, I'm deducting regular depreciation, just a straight line over 27 and a half years. And let's say I've taken $20,000 of that by the time I'm ready to sell the property. For the improvements, I'm actually able to deduct all of that in year one. I take bonus depreciation or Section 179, any sort of accelerated depreciation method. And I'm able to deduct that and save a bunch of money in taxes in the year that I buy it. So I'm all in this property, 120 grand. I've taken a lot of depreciation on it. So let's say I list it and sell it for $150,000. In my head, I'm thinking I've got a $30,000 gain here that I've got to deal with. I bought it for 100, I put in 20,000, I'm selling for 150, that's a $30,000 gain. The reality though is that we've taken a lot of benefits from the depreciation that we've taken, and so we have to add that back. Depreciation is tax deferral, it's not a tax write-off, and that's what most people don't realize. So we basically have to take all that benefit that we got in prior years, and we kind of have to pay the piper this year. And so the way it works from a tax perspective is we have to deduct from our cost basis in the asset any depreciation that we've taken. So we have to take, we've taken $20,000 in regular depreciation on the property, the building itself, and then we took another $20,000 in accelerated depreciation. So really our gain is $70,000 because we've got an additional $40,000 in depreciation add back for this property. And the way the actual tax calculation works is a little bit complicated, but we can break it up into three parts. Part one is that regular capital gain that we talked about from the start. So I sold it for $150. My original cost basis was $120. I've got a $30,000 capital gain. That's the most favorable part of this gain. And that's just taxed at capital gains tax rates for federal purposes, which is 0, 15, or 20%. Don't include state taxes or net investment income tax or anything like that. But the next part is the $20,000 in gain that I have from the actual building, from the depreciation on the building, more specifically. And so that's what we call Section 1250 property. Section 1250 property is taxed as ordinary income at your marginal tax rates up until your marginal rates reach over 25%. It's a max rate of 25%. So if I'm in the 22% marginal bracket, I'm likely going to pay 22% on that gain federally. If I'm in 32%, I'm going to be stuck with 25%, which is good. The worst part is the last part, which is those improvements. Anything we took accelerated depreciation on, basically anything that's not the actual building or structural attachments to that building, we're going to pay ordinary income taxes at a max rate of currently the highest rate is 37%. But again, it's just your marginal bracket. So take all your other income, figure out what your taxable income is and what your marginal rate is based off of that. That's likely what you'll pay, again, just for federal purposes. If you want more in-depth projections, you've got to add in things like net investment income tax, which can be 3.8%, state income taxes, depending on where you live, all that type of stuff. So that's basically the gist of it. There are ways around this. Section 1031 exchanges, which we'll talk about next week. And then, the other thing is that suspended losses can sometimes reduce this gain. And that's another thing we talked about in a previous week. So for more insights and updates like that, some more in-depth analysis, subscribe to the newsletter. We send it out every week, or at least we try to, and you can get more information there.